One item investors are looking at is the lack of volatility in the market. We told you about this VIX index yesterday, Wall Street's so-called fear gauge, closing at the lowest level in nearly 25 years Monday. Is that an ominous sign that people are not worried about anything? Joining us right now, Janney, Montgomery, Scott, Chief Investment Strategist, Mark Luschini. And Mark, it's good to see you. Thanks so much for joining us. Your reaction to the volatility and whether or not this is I don't know, something to worry about.
Well, or the lack thereof.
Yeah,
and,
lack of. That's what
pointed point in terms of it being sort of the granddaddy, the legacy instrument, the so-called fear gauge that everybody's looked at and sort of measured by way of saying once it reaches these levels, it's indicative of elevated risk or conversely low risk. We also looked at a couple things. For instance, the Minneapolis Federal Reserve published a survey recently that reported respondents less than 10% expecting a 20% correction or more in the next 6 months. That's the lowest since 2007. The Yale Crash Index, which is a contrarian indicator by way of, once again, asking respondents the likelihood of an imminent crash, once again, the lowest in more than 10 years. So there's a couple of other inputs there that, while you could challenge the efficacy of the VIX index, are all pointing to the same thing. Now, there's a lot of liquidity sloshing around the world looking to be treated more favorably than perhaps where they are on a local basis. And, the U.S. is a low beta equity Bourse by volatility standards. There's the TINA principle that's alive and well. There is no alternative.
There is no alternative, right?
Of course. And the fact is, things are reasonably good. We happen to have a fairly sanguine view about equity and economic conditions at the moment. So I think put that all together, and it's a reason to say it's deserved to be low. Whether it should be at low since 1993 or not is a debate, but it should be low.
Mark, do you really find, I mean, if the low volatility seems to be more of a complacency measure than, are you more worried about complacency versus euphoria, which tends to be the kind of market environment where I tend to get worried?
Well, I would agree with you there, Michael. Obviously, as been said, buy when everybody's fearful, sell when everybody's greedy or euphoric. And I think we don't have necessarily euphoria as much as we do complacency, which I think means that the overdue correction that everybody's expecting, not us necessarily thinking is going to be considerable in size or in duration, but its likelihood seems prime, is one that should be bought rather than necessarily derail one from having a more bullish view about capital markets in general. And so I think the complacency is breeding an environment where it might not take necessarily bad news, just disappointing news on either the economic front or perhaps even on the political front by way of, for instance, corporate tax reform not coming through as quickly, or if it's corporate tax reform light, not with the same impact on profitability that the markets put a big down payment on.
And that's how you link the firing of Jim Comey to your stock market, is that you have a new firestorm that just started down in Washington, D.C., and it certainly now turns the attention of all lawmakers, be it in the House or the Senate, to this, to the FBI's investigation of any potential collusion between the Trump campaign and Russia. You name it, now they're really distracted down in D.C. How does that play out in the market? Well,
you're right. I mean, it's consuming resources that otherwise would want to be devoted to the sequencing of health care reform and getting that through, so hopefully Congress and the administration can move on to corporate tax reform. So to the extent that these things that are a component of our fat tail president, where we can get some massive upside surprises coupled with some massive downside surprises, are manifesting in some of the downside issues now, and it continues to sort of usurp what the market wants most, which is corporate tax reform. That's a game changer.
It's an interesting point that you raised. Do you think that's why markets are down today?
I think
it's only 50 points, but I'm just wondering if what Dagan's saying is playing out. People are thinking, oh, okay, let me connect the dots here. There's a distraction going on here. That means the agenda gets pushed out.
Yeah, I mean, I think there's an element of that. I mean, we are at full valuations. I think we've kind of seen what we're going to get out of earnings season, which has been good, which is great.
15% higher on profits, 15%.
Yeah, it's been fantastic.
And importantly, revenue's up 5.3% ex energy.
That's a good number.
So that's very good. But, how many times can you buy that? So it's kind of a situation where I think the market's stuck in search of a catalyst at the moment, and this isn't a positive catalyst, to say the least.
Kirsten?
Yeah, no, and I wonder, too, there were announcements made about possible extra troops going into Afghanistan and the possibility of us really engaging more in the Middle East, and I'm just wondering on the foreign policy front, with so many threats and potentially, getting back involved in Afghanistan, does that have an effect on how people are investing and looking at this market as well?
Well, we've known the Middle East to be a concern and different phases of confrontation over the years, and it hasn't necessarily put the market back on its heels. But at the same time, even though it may not have a direct economic impact that's necessarily material by way of measuring its influence, particularly here in the U.S., it's once again causing consternation as it relates to geopolitical activity, which we already know has some heightened risk associated with it, not only around the Middle East, but particularly North Korea, movements in and around the South China Sea, confrontations between North Korea and whether China's going to help itself.
Yeah.
Exactly.
It sounds like you've got your money in market in stocks, but you're not buying new right now. Is
no, we're long, and
you're
we'd
long.
Be buyers,
you're still
most
buyers.
Definitely. But I think one has to be careful about where they're allocating their capital today to get treated most favorably.
All right, we'll leave it there. Mark, great to see you.
Thank you very much.
So, in terms of a sector, give me one that you think that's worth buying right here.
Well, actually, from a contrarian standpoint, one would look at energy. I think the supply-demand situation is going to evolve into one where demand is going to usurp the massive amount of inventory that exists at the moment and help to push up energy prices. So I like North American shale plays.
Mark Luschini, great to see you.
Thank you
So much.